Hey everyone. Welcome back to FX Limit, your go-to channel for all things Forex trading. In today's video, we're diving deep into one of the most exciting regions in the Forex market, the Asian trading session. Specifically, we'll be exploring the best fundamental factors you need to consider when trading the Asian Forex markets. Whether you're an experienced trader or just starting out, the insights we share today will definitely help improve your trading strategy. Now, the Asian Forex market is known for its distinct trading style and market conditions, so it's essential to approach it differently than, say, the European or North American sessions. For those of you who enjoy trading the likes of JPY, AUD, or NZD pairs, understanding the unique dynamics of the Asian market can give you a serious edge. First up, let's talk about the economies that drive the Asian session. You're primarily looking at Japan, China, Australia, and New Zealand. These four economies play a major role in shaping price movements during this session. And here's a tip. One of the fundamental factors to watch out for is interest rates. Central banks in these countries, like the Bank of Japan and the Reserve Bank of Australia, are constantly influencing the market by adjusting their interest rates to manage inflation and economic growth. Interest rate announcements can lead to major price movements. So, if you're trading JPY or AUD pairs, for example, keep an eye on interest rate decisions, monetary policy statements, and any unexpected changes in inflation targets. Often, these announcements occur during the Asian session, which gives you an advantage if you're focusing on pairs like USD, JPY or AUD, USD. Speaking of interest rates, let's briefly touch on how the FX Limit Apex Trend Indicator can help you navigate these market shifts. With its advanced algorithm, the indicator can easily detect trend changes based on the latest fundamental data. So, if interest rates are pushing a currency pair in a certain direction, the Apex Trend Indicator will provide timely buy and sell signals, helping you make smarter, data-driven decisions. It's a great tool to have when the fundamentals start shaking things up. Next on the list, we've got GDP reports. Gross domestic product reports are significant, especially for economies like Japan and China. Why? Because these numbers give traders a look into the overall health of a country's economy. Higher GDP growth generally indicates a strong economy, which can lead to stronger currency value. On the flip side, weaker than expected GDP growth can weaken the currency. So, if you're trading during the Asian session, keep an eye out for those GDP reports. They can trigger substantial volatility in pairs like USD, JPY or AUD, JPY. And again, this is where the Apex Trend Indicator comes in handy. Since the Asian market can be less liquid and sometimes more volatile due to lower trading volume, having a tool like the Apex Trend Indicator helps you spot trends faster and with greater accuracy. Plus, it doesn't repaint, so you won't have to second-guess your entry or exit points. When the Apex Indicator detects a downtrend, for example, you'll see it instantly reflected on your charts, allowing you to trade with confidence. Now, let's move on to another critical factor, trade balances. Trade balance data, especially from Japan and China, can have a strong influence on currency values. When a country exports more than it imports, it's called a trade surplus, and that's generally positive for its currency. On the other hand, a trade deficit could weaken the currency. Japan, for instance, is a huge exporter, and its trade balance figures can significantly impact the JPY. If you're a trader focusing on yen pairs, this is a piece of data you don't want to ignore. It's also worth noting that Japan's economy is very sensitive to global demand, especially for goods like cars and electronics. So, any disruptions in global trade, such as tariffs or economic slowdowns in key markets like the US, can cause significant movements in JPY pairs during the Asian session. This is why combining fundamental analysis with technical tools is so powerful. While you're keeping tabs on the trade balance data, the FX Limit Apex Trend Indicator is there to give you real-time signals. You'll know whether to go long or short on a currency pair based on the most recent trade data and market trends. It's that perfect combination of fundamentals and technicals that makes all the difference. Let's not forget about geopolitical events. In the Asian markets, geopolitical tensions can cause rapid market shifts, especially in currencies like the Japanese yen, which is often seen as a safe haven currency. Political events, elections, or even natural disasters in this region can lead to sharp price movements in the forex market. For instance, when tensions rise between countries like China and the US, you may see traders flocking to the yen as a safe haven. This can cause rapid fluctuations in yen pairs, which is why it's essential to stay informed about the geopolitical landscape when trading the Asian markets. So, how can you stay ahead in such fast-moving situations? The Apex Trend Indicator is designed to help you react quickly to these changes. With its non-repainting signals, you can catch new trends as soon as they form, even during highly volatile periods triggered by geopolitical news. And trust me, having this kind of insight at your fingertips makes a world of difference when market conditions are unpredictable. Lastly, let's talk about commodities. The Asian forex market is closely tied to commodity prices, especially when you're trading pairs like AUD, USD or NZD, USD. Australia and New Zealand are big exporters of commodities like iron ore, coal, and dairy products. So, any major shifts in commodity prices can directly affect the value of the Australian dollar and New Zealand dollar. For example, if iron ore prices are rising, the Australian dollar may strengthen due to increased export revenues. On the flip side, if commodity prices drop, the AUD could weaken. This relationship makes commodity prices a key fundamental factor to monitor when trading the Asian session. And again, the FX Limit Apex Trend Indicator can be an excellent ally here. Whether you're tracking the AUD or NZD, the trend scanner helps you quickly identify how these currencies are reacting to shifts in commodity prices, so you can place your trades accordingly. It's like having an extra set of eyes on the market, making sure you don't miss out on any profitable trends. So, to recap, when trading the Asian forex markets, you want to keep a close watch on interest rates, GDP reports, trade balances, geopolitical events, and commodity prices. These are the key fundamental factors that drive price movements in this session. And when you combine this knowledge with the power of the FX Limit Apex Trend Indicator, you'll have a robust trading strategy that covers both the technical and fundamental sides of the market. Thanks for watching. If you found this video helpful, don't forget to hit that like button and subscribe to FX Limit for more tips and strategies to enhance your forex trading. See you in the next video.